So if you are sitting there right now, jumping into trades that look perfect, watching them go in your direction for a few minutes, and then getting absolutely smoked out of the market on what feels like a random reversal, I want you to pay very close attention to this video, because what I'm about to share with you is the exact rule that took me from a trader who was constantly getting wicked out of positions to a trader who finally started letting the market actually confirm price action before risking a single dollar. This one rule is called the Candlestick Closure Rule, and it is, hands down, the simplest, most overlooked, and most powerful piece of price action I have ever added to my trading. It doesn't require an indicator. It doesn't require a paid course. It doesn't require you to stare at charts for 14 hours a day. All it requires is a small shift in how you read what the market is actually telling you on every single candle that prints. And in today's video, I'm not only going to break down exactly what a closure is and why it matters so much, I'm also going to show you the exact step-by-step way I use closures to filter out fake setups, dodge unnecessary losses, and stack confirmation on the trades that actually have a real edge behind them. We're going to go to real charts. We're going to look at real examples of what a confirmed move looks like versus a rejected move. And by the end of this video, you're going to look at price action in a completely different way than you did before you hit play. So if a rules-based approach that finally gets you out of guessing and into validated entries sounds like something you want, go ahead and smash that like button for me. Hit subscribe if you haven't already, and let's get started. First things first. Before we can even talk about how to use closures to filter trades, we have to make sure we're on the exact same page about what a closure actually is. Well, if we're looking at a 1-hour chart here, let's imagine these candles are hourly candles. That means every hour that passes, a candle will form. And at the end of the hour and the start of the new hour, the candle will close. So, for example, this would be our closure. This would take place at the start of a new hour. This would be the open price of the next candle. At the end of that hour, once again, we get a closure. And this continues. We get a closure, an open, at the start of each hour. So a candle closure is just where the candle is when the new candle opens. In this instance, the closure is here. The closure is then there, 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 and then all the way up there. Okay? Now the reason we need to wait for these closures is because until a candle closes, it can reverse on itself. Now, if we take a look at this instance, we're in an uptrend in this example. The market's uptrending. We formed a high. The market then came down, formed a higher low. Now the market's pushing up to form this potential higher high. If the market was able to close over this swing high, that would open doors to continued uptrending movements, meaning we could continue buying this market because we know it's going up because it's continuing to make new higher highs. But if the market does not close above, and instead the market does this and pulls back down before that hourly candle closes, if it closed down here, then this would actually be a rejection of the high. Because when we're looking at candles, we have the bodies and we have the wicks. The body is this large block area. The wick are these sticks that we get on top or below candles. Wicks show attempted prices within a given time frame. So in this instance, this wick shows us that the market attempted to go this high, but it actually got rejected, and the closure ended up being here. Now this means that the only confirmed price action within this price range is between this low, the open price, and this high, the closure price. Anything above that was just attempted price, also known as rejected price. So this is rejected price action. And then this is confirmed price action just here. Now what does this show? Well, this shows the confirmation has actually confirmed lower than the previous swing high. And the only push above that we had was a wick, which was rejected. So this market attempted to push higher but failed to close above, which actually rejects entirely the concept of seeing closures and continuations above this level, and instead suggests that maybe we could move even lower, because we haven't closed above the high. So we've rejected a new high, maybe indicating that we could be ready to turn into a downtrend. Now, if you saw this candle while it was open and it's moving up and down, and you decide to buy this candle before it closes because you think that it's closing above the swing high, well, if the candle then pushes all the way back down here, you've bought on unconfirmed price action. You've actually bought into a rejection of higher prices, which means the likelihood of your trade working out and not instead doing this is now considerably lower. And it's likely this trade could reverse on you. So if you bought up here during this push up, you had your stop loss here. Well, then it's very possible the market could even sink and stop you out of your trade without actually playing off at all. If you wait for the next hourly candle to open, so you wait for a closure, and the next hourly candle opens like this, for example, well, now you have that confirmation. So the likelihood of us continuing even higher is actually now pretty much set in stone and a lot more likely, because this market has proven to us that it's ready to make new highs. So that's why we need to wait for closures, because if we don't get a closure and instead we get a wick, well, then it's likely that the market will flip on us, or at least the probability of the market flipping on us is a lot stronger than it would have previously been, which means you can get caught up buying against movements like this that could instead actually lead us into a new downtrend. So following on from that, if the swing high was rejected, telling us not to get into a buy trade, and then the market moved lower and pushed past the previous swing low, well, this could potentially open the doors to trading the other way, which could completely flip our bias. And if we were aware of this and we waited for confirmations, we'd be able to take advantage of this new bearish price action. But what could also happen is actually we go and reject the low as well. So taking a look down here, let's say we pushed down initially. We formulated some bearish price action. But then before the candle closed, we had a push back up like this. And then we closed as a bullish candle once again. Well, now we are seeing the same thing again. We're seeing a rejection of this swing low. This is basically showing an area where sellers were pushing the market down. But at some point down here, buyers took massive control of this market and ended up running it back up to close at this point. If following on from this point, we then had a bullish candle that managed to go up and close above that previous swing high, so we'd be looking around this point here, well, this would then validate the buys finally, okay? Because what we've actually shown is an attempt to go higher that failed. Then we had an attempt to go lower, which massively failed, followed by an attempt to go higher, which succeeded with this closure. And if this candle was to close up here, then we could continue with our bullish ideas, potentially looking to buy on pullbacks to take this market higher. So really, we have to wait for closures, because you've seen just how dynamic this market has been. And in this example, I've just showed you how you could have been tricked twice if you hadn't waited for candles to close. First, at this top point up here when the market rejected the high, and second, when the market rejected this low. Now, obviously, this can be a big back and forth, which can be hard to get your head around. But really, it can all be solved by just waiting for the candle closures like this that we see here. Because if we wait for a closure above or below a swing point, then we have the confirmation we need to understand whether a market is building strength in one way or the other in a meaningful manner. So whichever time frame you're looking at, whether it's the 1 hour or the 4 hour or the 1 day or the 1 minute, it really doesn't matter. You just need to always wait for those candle closures to occur. When you get a closure like this above or below a swing point, you are ready to go with your trades. But if you get rejections like this one and this one here, then you should just wait out of the market until the market tells you to make a move. Let's go through an example of this now. Here's a market that's recently begun showing some bullish momentum, right? We've got higher highs and higher lows building up when we look at it from an internal structure standpoint. But if we zoom out, you'll notice that the bigger picture is actually a downtrending market, yeah? So the overall direction is bearish, while this smaller portion is bullish, where we're presently seeing these higher highs and higher lows. Now, what we essentially have here is a small swing high. So what we'd be hoping to see is the market closing above this high, because that could open the way into some fresh uptrending movement, right? So from a supply and demand angle, let's say we were interested in buying from this region, provided the market manages to close above the high it's trading at right now. So if price closed where it currently sits, we might expect it to retrace back toward demand and then keep buying. This could be the signal that the market might be turning, since we'll have watched this high here actually get broken. So that exact spot could be marking a shift in the trend, right? We might be witnessing these buyers stepping in. Now, this is the moment where we need to confirm we're getting closures above this level, right? Above this swing high. If price can close above it, that hands us the confirmation we need to keep trading upward. But if the market doesn't close above, then we might instead be looking at further downside in this market because it would tell us the swing high has been rejected. So a rejection means no closure, and a confirmation means a closure above. That leaves us with two possibilities. The first scenario is that if we get the rejection, we'd switch to hunting for a sell. So a rejection could open the door to sells. If the market manages to close and hand us that confirmation, that gives us what we need to concentrate on a buy, right? So confirmation above, meaning if the hour wrapped up exactly where we are right now, that would be our confirmation to buy this market. If we reject and close below, well, that's a rejection. That isn't a confirmation. That isn't a closure. The closure has failed. We've simply seen rejected price action up there, which means instead we could go looking for a sell. Okay? So let's see how this unfolds. If we let this candle close and the following one open, we notice we've actually closed with a rejection here, right? So we got that rejection scenario we were discussing. This is where the candle closed and a new one began. The next candle's been mildly bullish so far with a few rejections, but nothing's truly confirmed yet. We need to watch how this market behaves. Now here we've spotted a small push lower, so we're beginning to get the kind of rejection we'd like to see. And now we've seen a small push beneath the prior structural low. Now that this market's starting to close a touch lower, we might be opening the door here to grab those shorts we were after. Now, naturally, we're watching for whether there's going to be major rejection again. Because remember, if we saw heavy rejections, the market could simply go and close back above this high and carry on, which is exactly why we always want to focus on closures. Now, since this area failed to close, we can basically rule out that demand zone. And instead, realistically in terms of targets, we'd be aiming to take this market back down towards some earlier swing lows, right? We've seen a failure to push higher, which means we could potentially find a chance to trade lower. Okay? So, watching this market, we've spotted some closures below. Right here, we first saw a closure under this level. Then we watched the market push down. We'd now be checking whether we can once again close beneath that level. And just as we have here, we'd now be eyeing chances to sell this market if we got a pullback. So, for instance, the setup we might consider would be something like this. We could sell there. We could place stops above the zone. And for targets, we could trade this down into one of those supply areas, right? So letting this market run its course, you see there we got the pullback, a tap into supply. Now the market's pushing lower, going after those swing lows. So that's a positive. That's what we want to see. Now, we've also seen there's been a closure under this first level. And now that we've reached this second level, what do we get? We got a closure. So let's quickly zoom in on that. You can see down here, the level where we banked profit on that first trade, we've got a closure. What does that tell us? Well, it tells us we can head lower. Had we rejected this level with a wick and bounced back up, that would be reason to maybe trade it the opposite way, right? We'd be thinking, okay, perhaps the market isn't ready to close below. Perhaps we're seeing rejection. So we might then see this market climb back to the highs. But because we've got this closure right here, we can now expect any pullbacks to basically hand us selling chances again. Now for this, what I'll do is drop to a 30-minute time frame to check if we have any refined areas left unretested. We've got this supply up top. Now, if you'd like to watch a video on supply and demand, click the card at the top of the video right now. I'll also drop a link in the description. But at this stage, we've got a supply zone that could be traded into. We've got closures showing us this market's going lower. The reason I'd use this for entry comes down to something called imbalance. Again, there'll be a lesson in the description. And because we've got the closures, we're now after continued downside. So if the market can pull back, we could look for a sell. This sell could carry on lower. For this trade, let's keep it simple and look at this open demand zone below. So our trade would look a bit like this. That'd be the position we could aim to take, and that would give us a chance to trade this market lower now that we've had closures. So let's see how it plays out if we run it through. We got closure, a second closure, which is good. We've got a wick here, but the market already closed below, so that's a good sign. It's pretty much what we want to see to confirm the downside. If we get closure, then a wick, don't stress about that wick too much because the closures have already taken place, right? Then we traded back to supply. We hit the supply zone. We got triggered into the position right here. As things stand now, the trade's still running. We haven't swept this high, which is where our stop loss sits. And then you can see the market's made a strong drive downward to fill that target, continuing the downside price action just as the candle closures we got here confirmed. We had the closures first under this level, opening the door to shorts. Then we had the closures beneath this level, opening the door to more shorts once the market pulled back. I do want to draw attention though to this area here, because here on the 30-minute, you can see the market actually did close, right? This level here closed above on the 30-minute. So even though the hourly rejected, couldn't we get fooled into the market from here? Well, what I want to address is time frame relevance. Now, remember we built this trade. We ran our initial setup analysis on the 1-hour time frame, right? So the hourly was the starting time frame. Now we're working on the 30-minute time frame as a follow-on from what we observed on the hourly. We're using that 30-minute, if you recall, just to find the more refined supply zones or spots to enter trades from, like what we've covered here. But the setup foundation was built on the hourly. So let's head to the hourly. You'll notice the swing high we first looked at didn't close above, right? We had rejections up there, dragging the market back down and genuinely opening the door to that continued downside we've now seen. The hourly being the most crucial time frame, since that's where our setup originated. Look down here where we saw those closures earlier. These still happened. These were confirmed on the 1-hour time frame, which is our setup foundation time frame, our primary time frame. Along with this closure here that we saw beneath this structure, this is also clear and visible on the hourly. There's no rejection. So when I mention time frame relevance, I'm simply saying when you locate a setup, use that time frame to confirm the setup, right? This hourly setup was the idea to buy if we closed above, sell if we closed below. So we want to be sure we're watching hourly closures or rejections. This here again was an hourly based setup. It was a possible buy if we close above, sell if we close below on the hourly time frame. So even though the 30-minute did close below 2, we used the 30-minute to locate the refined area. We only trust the setup because the hourly, the genuine setup foundation time frame, closed beneath that level where we wanted it to close. All right? If you spot an hourly swing point and a 5-minute candle rejects, don't worry too much because you might get another 5-minute candle that ends up closing the hourly bullish. But if you see an area like this, where the hourly failed to close above, yet a lower time frame did close above, trust the higher time frame, because that's where you found your setup. That's what's going to be the most accurate. So remember, always wait for closures before entering any positions, because these things prove whether a trade is actually worth taking or not, and it'll save you a ton of money on pointless losses while also helping you trade with greater confidence on the positions that have been validated. Now, if you'd like to learn how to turn this into a trading system, we've got a free course on our Telegram, which will teach you exactly how to build, validate, and test a trading strategy so you can become a profitable trader using what I've shown you today. Click the top link in the description to check it out. So thanks for watching, and I'll catch you in the next one.